HDFC Bank carries a 12.74 trillion market capitalization. It's a structural behemoth, yet this heavyweight has become the primary drag on the broader index. Looking at this dual-line chart, the primary data reveals a steep decline. Over 12 months, HDFC delivered a negative 17.34% return. Compare that directly to the broader index. The Nifty 50 contracted 4.84%, showing HDFC drastically underperforming the index it heavily weights. The year-to-date figures confirm this isn't a temporary quarterly fluctuation. The downward pressure has been relentless. An institution of this size is expected to provide stability. When it trades with the characteristics of a distressed asset, the market is forcing a strict recalculation of its value. Which brings us to the live order book. The current traded price sits exactly at 827 rupees. This 827 price point is the current market consensus, a valuation we can deconstruct by looking at the specific metrics used by institutional desks. To understand how that price was reached, we need to dissect it using two metrics: comparative valuation multiples and institutional volatility profiling. Analyzing these metrics in a vacuum might be an interesting academic exercise, but it offers zero actionable insight for a portfolio manager. The only way to quantify the specific market positioning of HDFC at 827 rupees is to map it directly against its closest private sector rivals. Let's start with the raw fundamentals. HDFC Bank is an absolute cash engine, pulling in a recent total income of nearly 89.8 thousand crores. Filtering that down to the bottom line, the bank generated a highly robust net profit of 19,221 crores. This chart maps how the market values those earnings. Despite massive profitability, HDFC is currently assigned an adjusted price-to-earnings ratio of exactly 16.20. Look at how that stacks up against ICICI Bank, which is currently commanding a higher multiple of 17.60. Then there is Kotak Mahindra, pushing even further ahead with a significantly higher multiple of 20.07. The final major peer, Axis Bank, trails just slightly behind at 15.75. When you look at the complete matrix, HDFC is pinned squarely in the lower middle tier of its own peer group. Kotak operates at a fraction of HDFC's 12.74 trillion scale, yet the market willingly pays a substantial premium for its earnings. Even against ICICI, an institution much closer in structural size, capital is clearly favoring ICICI's current risk-adjusted trajectory over HDFC's. The numbers reveal a distinct reality. The market is projecting slower forward growth, or demanding a steeper risk premium, for HDFC than it is for its primary competitors. That risk premium becomes obvious when we shift from valuation multiples to institutional risk profiling. Specifically, we need to look at the annualized volatility metric. HDFC Bank is currently operating with a highly elevated annualized volatility of 25.79%. To contextualize that 26% variance, this band maps the stock's trading corridor. It reached an upper limit of $1,020.50 over the past year. The floor of that exact same period completely collapsed down to $726.65. Dropping the current spot price onto the band shows exactly where we are today. At $827, HDFC sits precariously in the lower half of its historical trading range. There is a common assumption among professionals that all mega-cap banking stocks inherently function as low-volatility portfolio anchors. An asset swinging with a 26% annualized variance breaks that blue-chip assumption for the current market cycle. This leads to a critical microstructure question. Is this wide price variance a symptom of thin liquidity, or is it purely directional trading from institutions? HDFC has a massive free float market cap of $12.62 trillion. There is no shortage of available shares on the exchange. We can verify that by checking the liquidity profile. This order book visual demonstrates an impact cost of exactly 0.01. Mathematically, a 0.01 impact cost means execution risk is near zero. Institutional algorithms can move massive block trades onto the book without forcing the price to slip. Because liquidity is supreme here, the volatility is entirely informational. The market is efficiently and purposefully repricing HDFC without any friction in execution. We can synthesize all these independent data points into a single cohesive mental model. This matrix uses the y-axis to chart market capitalization, which represents the pure scale of the banks. The x-axis tracks the price-to-earnings premium the market is willing to pay. Plotting HDFC shows its true structural position. It sits incredibly high on the scale axis, but remains highly restrained on the valuation axis at 16.20. When we drop in ICICI and Kotak, they map much lower in sheer scale, but are pushed significantly further to the right by their valuation premiums. Now we apply the final risk factor. This expanding radius represents HDFC's 25.79% volatility, mapping the sheer variance surrounding its current valuation. This matrix isolates exactly what is happening on the exchange. HDFC is a total statistical outlier, a supreme scale asset currently trapped in a highly conservative, high-variance valuation penalty box. So what does a 827 rupee entry point actually mean for an institutional portfolio right now? On the upside, the microstructure is flawless. Buyers secure supreme, frictionless liquidity with a near-perfect 0.01 impact cost. The cost of that liquidity is absorbing the turbulence. You are buying into an asset throwing off 26% annualized volatility. That turbulence is the mechanism of price discovery. The market will continue to thrash until HDFC finds parity with the growth premiums currently enjoyed by peers like ICICI and Kotak. The data reveals a highly liquid trillion-rupee giant in the middle of a persistent, mathematically observable valuation reset.